Welcome back. You're watching Stock Watch with me, Zinati Kuma, and join me to unpack your stock-related questions tonight. Chris Reddy from All Weather Capital and Graeme Körner from Körner Perspective. Be sure to send your questions via email to stockwatch@bdtv.co.za or SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. It was quite interesting to see quite a lot of green in the markets on the JSE, and even those US markets that kind of started off mixed. We did see the S&P 500 and the NASDAQ going further into the green. And I'm wondering if this is just, Chris, starting with you, because investors had been worried about, or they are worried still about the trajectory of interest rates as they digest Fed Jerome Powell's comments around that. Is this rebound today just maybe a blip in a trajectory of downward pressure in the markets?
I think maybe just starting off with the SA, I mean, I think we took our cue from the strong finish in China this morning as we saw further buying in the tech names as the government companies basically came in to support that market. So you can see in the SA market, I mean, NASDAQ process had a very strong day, up both about 3% on the day. And then I think some of the other specifics that drove certain stocks, I mean, we had an update from MTN with regards to the MasterCard transaction that was announced last year, but at least we had details now on the amount paid from MasterCard. So I think that also helped boost MTN on the day. So I think there were some stock-specific factors that drove our SA market. On the US side, I mean, I think the US also had a very strong start to the year, especially with regards to the Magnificent Seven stocks. So maybe just some kind of catch-up trade coming through there. That being said, though, the US NASDAQ has actually turned a bit weaker in the afternoon, and that's mainly coming through in those Mag 7 stocks. So the likes of Meta, Microsoft, Amazon, all slightly lower now. So two different factors driving the two markets currently.
Yeah, and actually on that, I mean, Chris mentions that the JSE got a mostly high handover from those Chinese markets, and of course, we know the authorities trying to intervene in the stock market after we saw that big sell-off where those Chinese stocks reached a 5-year low last week. Graeme, would you say that there is a significant turning around there in terms of intervention and stimulus in the Chinese market or not?
Yeah, so I think a lot of people would say it's kind of long overdue. You know, the Chinese authorities intervene in virtually everything else from a political and economic and social point of view. You know, they might have been a little bit late to the party. But clearly, the markets loved it. If you look at, you know, the Hang Seng was up, I think, 4.25%. You know, China mainland was up, I think, 3.7%, if memory serves. And as Chris said, you know, our market was stronger on the day, and convincingly so. If you look, I think we were up 0.7 or 0.9% on the top 40 and the all-share 0.7. But, you know, Naspers and Prosus did a fair amount of that heavy lifting, you know, both up sort of in the 3%, with, you know, quite a few of the other, let's call them sort of more SA Inc. type of indices looking a little bit soggy. So small caps, mid caps, consumer stocks, So I think generally our market was almost exclusively buoyed by China, but then obviously later in the day European markets got going, because I think the tone was skittish in world markets this morning after the sell-off in the US, and even now. You know, if you look at the NASDAQ, I think it is a little bit choppy, and there is a little bit of anxiety given, as Chris was saying, the valuations and the rally that the seven have had.
Yeah.
But I would say, you know, almost 80% of today's rally on our market was thanks to the Chinese intervention and the rally in Hong Kong and China.
All right. Yeah, we did see Naspers and Prosus there being the biggest gainers really there. Up almost 4%. Let's go into the questions. There's a question here on Tiger Brands. Is Tiger Brands worth looking at for inclusion in a portfolio at the current price? It is not a share mentioned a lot on your program, but seems to be stable with good dividends, or what would be a better long-term buy? Actually, we did have, I think it was Grant Nader, if I remember correctly, last week picking Tiger Brands as his stock pick. Chris, would this be one that you would be looking at or not? Of course, I know that they have had their internal challenges, but just from an investment case point of view, what would you make of Tiger Brands?
So I think similar to what we saw with some of the other retailers last year, I mean, Tigers obviously had some of their own goals with regards to the rice strategy. There was pressure on some of their volumes in some of the divisions, so a bit of pricing pressure to actually push onto the consumer. But that being said, I think there was some positive management change that came through. There's a clear strategy to actually turn the business around. So it is something that we are looking at. And I think, like, as in the case of the retailers, I mean, you do have a bit of a weak base that the company will be circling, because it was quite impacted by the impact of load shedding last year, and we have seen now that load shedding has abated somewhat. So we're hoping that a lot of the bad performance is actually behind Tigers now, and the new management team can actually start making some positive changes there.
Yeah. Graeme, actually, what do you cling on here in terms of Tiger Brands? If you're looking at it, do you cling on to the fact that they're changing strategy and rejigging strategy within the business, or do you look at the impact of the broader economy now that things are getting better? As Chris said, load shedding is, we're looking at load shedding getting better this year, input costs coming down. What do you cling on? The business's internal strategy or the macroeconomy that is turning around?
Well, I think, I've gone on record many times over the last few years to say Tiger Brands is not a company that I like. It was a bellwether in every South African portfolio, 15 years ago. But our big concern with it was that, they were increasingly, and I do agree that the model has changed, and I think they've become a little bit more receptive to the conditions. But they were trying to sell premium product into a fundamentally poor country, and they were trying to sell, a tin of baked beans. I often use that as a silly example, but instead of for 8 Rand a tin, for 9 Rand a tin, and it would just never fly. And I think one of the problems, as I've said many times, is of course the retailers, all of them, but particularly the mighty Shoprite and Pick n Pay, have definitely moved towards white labeling, and that doesn't suit the likes of Tiger Brands very well. So I think they have been innovative. I think the management changes have been good. But, for me, if I look at this business, if I go back to 2013, they delivered earnings per share of 17.37 Rand. I think forecasts for September of this year are 17.79. So if you have to be brutally honest, in a decade, it really hasn't done much. I agree that in the last year or two, consumers have been hit hard, disposable income is under pressure. But I think on balance of argument, it is still a premium brand business that's trying to sell into a fundamentally poor population. So I think it's going to be tricky. I'll give them the benefit of the doubt, and I think over the next 2 or 3 years they'll probably do better. But I think that's already to a degree in the price. I think for if memory serves, for September 25, which is a good year and a half away, the market's not even looking at $20 of earnings. So you're already well over a 10 multiple. So I don't see a reason to have to include it. It's also not defensive, which is what a lot of people, I think, in the past thought of it to be, because it produces food. But the problem is it produces food by buying wheat and maize and products in from the market, putting a margin on and trying to sell it. So I'm not mad about it. I think it's better placed and better run now than it has been. But I personally wouldn't add it to portfolios just yet. Okay,
seeing as though Graeme is the kind of more of the skeptic in this instance, would there be a better long-term buy in that food space, Graeme, that you'd go for?
Than myself. Sorry, you're talking to me.
Yes.
Yeah. I think just go with the retailers. They I think are the ones who will drive volume. Look, Shoprite. In our fund, we've now sold out of Shoprite completely. We think it's a fantastically run business, beautifully placed, to really eating everybody's lunch. but the multiple makes no sense, and the base is relatively full. So if you're talking about a business to own, I would say that, but I would rather sit the food sector and the retailers out right now, unless you've got a hell of a lot of risk appetite and you think Mr. Summers is going to turn Pick and Pay around, and I think there's a reasonable chance that he does it over the medium term. That could be the recovery play of all plays. But if you're looking for quality in the food sector, I would go with ShopRite, and I would just wait for the share price to come to me.
Yeah. Chris, just coming back to you, because I mean, you've mentioned some of the things that could be green shoots for Tiger Brands, but if you were asked to search in that food producer category, would Tiger Brands be the one that you pick above all, or would there be one that you think would be better placed in the long term?
I think the one that does come to mind is probably AVI. I mean, if you look at the most recent update, it's a very strong update across their foods operations. The only challenge, like what Graeme was mentioning, is that the stock has had a very good run of late, and probably does cause for some kind of patience around a better entry price to get into something like an AVI over a Tigers. I think in the mid 80s type of level, potentially a little bit rich at this level, so we'll probably wait for a better price to buy something like AVI. I mean, I agree with Graeme's sentiments on ShopRite as well, but I think if you just look at it from a foreigner perspective, I mean, many foreigners are happy to pay up 19, 20 times multiple as long as the growth is still there for the foreseeable future. And I think if you just look at some of the market share gains, the aggressive space rollout that ShopRite and the Checkers format is doing, I mean, it's not unforeseen that they could still deliver very, very good growth for the next 2, 3, 4 years. And I think capital return is key on their minds. They've reduced the Africa losses. They've actually reduced the Africa footprint quite aggressively. And I think just like some of the other retailers, they are also circling a very high load shedding base. So once you take into account normalized diesel costs and the likes, you're probably going to see an improving total return from ShopRite. So that'll hopefully help the rating and maybe even get them closer to, or probably help justify why it could move closer to a clicks type multiple in our market.
I want to go into more questions. There's a question here on transaction capital. The announcement that We Buy Cars will be separately listed, is it not the opportunity to buy transaction capital at this low price? Graeme, I'm going to start with you. I feel like investors have been asking themselves and us if they can buy transaction capital at this low price since the crash. But with this now new development of We Buy Cars potentially being listed, would you go in at this price on transaction capital?
So I think, I'm wired a little bit differently. If I have to ask myself, do I really want to do this? Does it look like a good story? Generally, I just walk away from it, frankly. So if I have to convince myself why I want to buy the thing, I feel like I'm looking for trouble, and trouble comes looking for us. I'm sure Chris will testify to that. So, I think We Buy Cars itself is going through a metamorphosis. I think that market has tightened up quite a bit, but it doesn't help you. If you buy transaction cap to get the listing of We Buy Cars, and we can just park the merits of We Buy Cars right now.
Yeah.
You're still going to be left with Taxi Finance Corp and the car repair businesses and stuff. So I don't think you're gonna get such a windfall and an unlock of the discount that. So I would say if you want We Buy Cars, then wait for the listing and see how it plays out. We've seen other listings in that space, do quite well and then fizzle a little bit. So yeah, I don't think, unless you like the sum of the parts, and you pretty much like everything or most things, I think it's crazy to buy transaction cap as a way of getting We Buy Cars. I would personally just wait. But I think all the components are in a difficult space right now. I think there's probably time. But I commend management for the effort in trying to create value and unlock that value discount or value gap that seems to be there. But no, I wouldn't rush out and buy transaction cap as a way of getting We Buy now.
Chris, actually, have you gauged what the appetite for We Buy Cars listing would be, because obviously we know that it's basically the best business out of Transaction Capital right now, but in the broader market as a standalone business, have you kind of gauged what the appetite would be like?
So I think, I mean, the closest peer is probably something like Motus, but I would probably say that We Buy Cars, there's an argument to make for it to be trading on a higher multiple. I mean, much bigger market share. They turn over the stock a lot more faster than what you'd find in Motus, so better working capital management from that perspective. And they also play in that second-hand market, so hopefully, I mean, in the slightly older segment of the market, so maybe some better margins to come through in a We Buy Cars type of operation. That being said, though, I mean, if you just look at the new vehicle sales figures out of NAMSA, it doesn't point to a great outlook over there. I mean, it's quite clear that the consumer is shopping down, and you can see that clearly with regards to the market share growth that we've seen in the likes of Suzuki. You can see the amount of Cherries, Havals on the road as well, and less so. I mean, it's obviously impacting something like a BMW, Audi, and Mercedes. So that premium segment is coming under a lot of pressure, but that also bodes well into We Buy Cars segment, because I mean, there's obviously going to be demand for the second-hand car market. So we are still waiting for the circular to come out with the details with regards to where that offering will probably be placed. But I mean, I agree with Graeme in terms of just, if you do want We Buy Cars, maybe wait for the separate listing of We Buy Cars, because we still are waiting for clarity around just the financing structure and the ability for SA Taxi to roll the upcoming maturities. You know, I think that's where the pressure point is. Newton is performing quite well. So the pressure point is still SA Taxi, and it doesn't seem as if that the conditions are changing for the taxi environment right now.
All right. Let's go into the hotel space, City Lodge. To what extent does City Lodge Hotels balance its room rate and occupancy level? City Lodge uses a flexible room rate to adjust it with swings in demand. I presume there is a bottom line under which they would not reduce their rate, and that an X percentage of occupancy is required to break even, for example, 55% perhaps. Does the panel know how room rates are set? Graeme, would that be something that you have looked into?
Yeah, so I can't remember the numbers offhand. I mean, we did meet with management and they shared it with me, but my years are unfortunately eating away at my memory a little. So from what I can remember, I think it's sort of 50% or thereabouts is the base rate, and let's call that 1,200 Rand or whatever the number is.
Yeah.
And then the best way to describe it is it's like airline tickets. You know, the first 50% of the tickets go at a certain price, and then as they sell more and more, so the rates go up to 1,800 or whatever the case might be. So from what I can remember, the base rates are sort of up to about 50, maybe 60%, and then the algorithm obviously increases the price for the supply and demand. And there have been times, I think if you take something, like the BRICS Summit, you would probably find that then they were able to do really good business at good margin. And also for the guys paying those prices, they wouldn't even blink, because it's still, $50 a night or whatever it is.
Yeah.
So I think, I don't know if I've answered the question, but it's kind of like an airline would price tickets, which is a fairly smart way of doing it. But I think it's one of the things that we quite like about the way management have embraced this new future.
Yeah.
But equally around the food and beverage offering. They've been doing some really good things, post the COVID fiasco.
Yeah. And actually, the second part of that question is, does the panel believe City Lodge will be able to raise room rates better than they have been able to? I mean, wouldn't that go with demand and increased occupancies? For example, Graeme talks about the BRICS Summit, and even the tourism department is really trying to boost that business tourism in the country. And obviously, more tourists starting to come out as things really normalize. Would I be correct in saying that they still do have a lot of room to raise those rates, Chris?
I think it's provincial dependent. So places like Cape Town, where you are seeing a lot of tourism flow coming through, especially with the flight data, given the limited amount of supply there, I think there is potential to increase those rates in Cape Town. Maybe not so much in some of the other geographies like KZN or even in Gauteng, because you've got quite a bit more supply, and we have obviously seen a big tilt into demand for Cape Town tourism. Plus, a lot of the conferences have also started moving down to the Western Cape as well. So I think they've got better potential in Cape Town, maybe not so much elsewhere in the country. Graeme?
Yeah.
Yeah, I think Chris is spot on the money. Sorry, especially Sandton, there is a hell of a lot of space around. But obviously, when you get these purple patches around conferences and the likes, it can boost them. But I think he's 100% correct. It's quite province dependent or city dependent.
Yeah.
But I think they're doing the best they can to sort of manage, for example, that very difficult Sandton market. And I think they're doing a very good job. If you look at the more recent results and updates, they're back to pre-2019 levels, which I think takes some doing. And they're also, interestingly, changing the mix. So it very much used to be just a local business travel market. Now you're seeing more leisure, more foreigners using them for periods of time, and I think some leisure travel in some of the provinces as well. So long may it continue. We like the company.
Yeah, all right. Well, let's get into commodities before we get to your stock picks. Of course, we were talking about China stimulus earlier on. And the question is Anglo American at buy at 430 a share? China stimulus seems to be coming through. Chris, would this be one that you would be plowing into with the China stimulus that is being poured into the market at this point?
Yeah, I mean, even outside of the potential excitement around China stimulus measures, I think Anglo American does offer you a lot of optionality at these levels. They have come through with a production update. I mean, they cut back their copper operations quite aggressively in this period. We've also seen some of the other copper peers also cut back in production over this period. So we do think that medium to long term that will be supportive of prices. And then you've obviously got a kicker from potential demand as China maybe rolls out a bit more infrastructure play over here. But I mean, outside of that, Anglo's has already said that they are looking at bringing in a partner for the Woodsmith fertilizer operation. So like what we saw with Cecil and Lake Charles, there is ability to actually bring in a bit of an equity partner in quite a big capex program, which also then releases some of the burden on the company to fund that capex. And then I think maybe the cherry on the cake in Anglo's is that given the share price decline, it does potentially pose quite an attractive takeover target, even for the likes of like a BHP, for example, just given how low the share price has moved relative to some of the other peers. So it is one that screens quite attractive for us on the diversified commodity plays.
All right. Well, we have run out of time, so let's get to your stock picks for today, gents. Graeme, what will yours be for today?
I'll go offshore for a change. There's a company called Diageo that makes some of the finest whiskies and other things in the world. I'm a keen fan of a lot of their products.
I thought Chris was grabbing a whiskey there, but it's just water.
Yeah, mine, it looks like water. No, but I think it's just got an incredible portfolio of companies. It's really a global business in every sense of the word. So if you take, for example, if they talk about geographic diversification through North America or Asia, it's just a beautiful wagon wheel of different geographies, different countries. Good brand portfolio, quite tilted to whiskey, but quite recently, so it's a business we like very much, but it's always been a little bit out of reach. Chris was saying foreigners are happy to pay sort of 20 multiples for growth, and Diageo was just out of reach. Recently, they put out an update to say that the Latin American and Caribbean operations were experiencing some sales pressure. Share price came off quite a bit, so I think let's call it £28. You don't have to buy it tomorrow morning. Pick a level at £28. I think it's a great business. This year's earnings will be virtually flat at £1.65 or thereabouts. But I think thereafter it's back to 5, 6, 7, 8% earnings growth. And although the PEG ratio is more than 2 times, that's what you pay internationally. So it's a brilliantly placed business that I think is offering an opportunity.
Yeah, all right. On your side, Chris, where are you finding opportunity?
Okay, actually going to pick a mid-cap property name, Dipula Income Fund. So Dipula, it's got about a 4 billion rand market cap. 65% of the portfolio is in retail, and then the balance is split mainly between office and industrial. The reason we like it, Dipula trades on just over a 30 times discount to NAV, and it's giving you about a 13.5 dividend yield, so quite solid income perspective, and then also you're getting at a discount to NAV. Management are aligned with shareholders. They've got a significant stake in the company. It has got a clean balance sheet, no funny cross-currency swaps, foreign operations, related party dealings, and the likes. And I think if you've seen some of the retail updates of late, I mean, the retail segment, specifically in the non-urban regions, is performing quite well. If you just look at some of the updates from Attack and Fortress and Vukile, so we do think that we're going to see quite a good update from Dipula as well. So the portfolio is performing quite well. It looks as if office has stabilized at these levels. So we're happy to pick up the yield from Dipula. And again, I think corporate activity, potentially an option in the name, just given some of the deals that we have seen in the sector. They do have a very strong portfolio as well. But I think we're not buying it for corporate activity. That's just a nice cherry on the top. We're just happy to get the yield and some kind of discount narrowing on the price to NAV.
All right. Well, thanks so much for your time and for your analysis today, gents. Really appreciate it. That is all for Stockwatch tonight. Thanks to our guests, Chris Reddy from All Weather Capital and Graeme Körner from Körner Perspective. Up next, the close. Stay with us.